Hey guys, welcome back to the Retail Age. So today we're going to talk about something that's been so talked about amongst retail investors, and that is dollar cost averaging. Well, friends around you probably all have some kind of DCA going on, right? But today I'm going to explain to you and show you why it has actually been working so that you can be convinced and not just blindly put your money in, right? So in case a sell-off actually happens, you know for yourself whether it's a strategy that you can continue sticking to. And also I'm going to share some of the ways that you can potentially beat DCA as a retail. Right, now let's dive in. So why has DCA been working out for the longest time? You've probably heard stuff like stocks only go up. Well, although that may be a meme, it may actually be true to a certain degree. So first, stock markets are actually structural bullish. Why is that? So here if you look at the different stock market participants in the global stock market, we have retail, real money, hedge funds, quant funds, and the passive ETFs. So hedge funds and quant funds, these guys, you can think of them as, citadels. They became infamous during probably the GameStop episode. So these guys basically go in fast, exit fast. They don't stick around for a very long time often and can potentially change their views from long to short and vice versa. So they actually cause a fair amount of volatility in the market. However, next part is really the key. If you look at real money, ETFs and retail, they combined make up about 70% of the market. So real money also, a lot of them are known as long only funds. And you can think of them like the BlackRock, Vanguard, and the other sovereign wealth funds of the world. These guys are called long only because they only go long. They don't actually take naked short positions, and if they have shorts on, it is most likely to hedge their longs, right? And then if you look at ETFs and passive funds, these are, you can think of it as, like your SPY ETFs, QQQ ETFs. Basically, when we put money in every month, these funds go to work and they just buy the market irregardless of levels. And last but not least, we have ourselves, the group of retails, who even though, we like to punt around sometimes, most of the times we are actually more long than not, right? So if you think about it, 70% of the global stock market participants are always almost long the stock market. So how can the stock market not go up, right? And if you look across the globe, these guys are the most active in the US because by nature it's the biggest market, it's the most developed, and therefore if you look at US, it has always been going up. Right, so next, the other reason why DCA has been working is because we actually live in an inflationary world. If you look at this chart, across all these different developed economies, it has the CPI has mostly actually been above zero, and that means there's been inflation over the past 20 years, right? And of course, the outlier here would be Japan. And if you look at Japan's stock market prior to 2020, for the past 10 years to that, it has really gone nowhere. It's been stagnant. And this lack of inflation is actually one of the biggest causes. I know how most of you have heard things like, inflation may be bad for the economy. But if you think about what inflation actually is, inflation is basically the price of goods rising. And who is selling us the goods? Those are the companies that are listed on the exchange, right? So if those companies have enough pricing power to actually increase the price of their goods, that just means that their revenue are going up as well. If their sales go up, their bottom line go up as long as they control their costs well and their margins are maintained. It just means that their share price as a nominal number will likely go up as well. So the stock market has actually been trending up over the years nominally because there's been inflation. Now let's move on to last but not least, actually one of the strongest drivers of market gains these 2 to 3 years since COVID. So since actually 1960, the money supply, we can look this up online, M2 money supply, it has already been steadily growing just because the economy has been growing. Governments need to spend money, issue out more money just because the size of the economy is growing. I think all that is normal. But if you look at 2020, since COVID, government has pumped in so much stimulus money. And if you look at the balance sheet of the Fed, it has gone up so sharply, right? And even though we have all heard, there's been quantitative tightening, Fed's cutting down balance sheet from 2021, 2022. If you look at how shallow, that dip on the graph is, it's not even material at all. And then before we know it, it's continuing to go up, right? So all these liquidity basically are liquidity available to be put into the market. And when times are good, you know that these liquidity are going to go into the market, right? So these 3 reasons have been around for a very, very long time, and money has been flowing into stock markets, especially in US, for the longest time, and that is why DCA has been working. Well, many people say that you can just do it without thinking because yes, these factors have not changed for the longest time, but I'm just putting it out there so that if one day one of these factors somehow change, then at least we can be aware of it and we can think to ourselves, would DCA still be the best way forward at that point in time, right? So now, how do we as retails potentially beat DCA returns? Okay, DCA probably gets you around 10+% a year if you're assuming you have mostly been invested in the US market over, say, the past 10 years. That's actually a very, very healthy return already. But if you want to actually try to make lump sum investments on top of DCA, you can quite easily actually beat and outperform these returns, right? If you do it properly. So when it comes to lump sum investing, one of the biggest pitfalls, I've heard a lot of people online saying is buy only during dips and don't buy when markets are at highs. Well, if you are someone who can time the absolute bottom and sell at the absolute highs, of course this is for you. But for 99% of retails, including myself, this turns out to be one of the biggest pitfalls, because you recall this chart, the dip that keeps dipping. You may think that, we've hit 200 DMA, we may think we've hit 100-day moving average, and it's a strong support level, etc., etc. However, when the market wants to sell off, it can easily break through these support levels, and this can be what happens. So if you look at this chart, how do you actually time the bottom? It's incredibly difficult. And once you mistime, you can easily sell off another 4 to 5%, and that is painful, right? On the flip side, there's the rally that keeps going. If you look at this chart, probably if you try not to buy when markets are high, you would have maybe, halfway through, you already think that markets are topping out. However, the uptrend just keeps continuing. And if at any point in time you're thinking about putting them on a lump sum and been holding off, then you would have maybe invested eventually at 10 or even 15% higher if you have been holding off. So what should we do, right? The key here is really to identify the trends, because like we mentioned just now in this chart, the real money and the ETF buying, these actually makes up trends. And trends are retail's best friend because you can follow them, right? So how then, knowing that we need to follow this trend, how then do we identify them? We as retailers have 2 forms of analysis. You probably heard of them, fundamental analysis, technical analysis. However, those can often be kind of misused and mispropagated. So fundamental analysis, many people just think of it as, doing fundamental research, finding out how much a company is actually valued. However, for retails, that is not our edge. If you recall what's our edge in my previous video, the edge of a retail, just to recap, is our ability to actually latch on to institutional buying, because those take time, and then knowing that the trend is there, to ride on that trend, because retails can enter and exit very easily, while big institutions take time. Because if you think about it, we as retails, we are not going to be able to find the next Nvidia, the next Palantir before institutions. Why? Because they have so much resources. They have full-time staff dedicated just, for example, in the tech sector, right? They have full-time staff talking to analysts at banks, meeting the company directors, meeting the board of directors of those companies they actually think of investing. They have such access, which retails do not. So there's almost no way that we could actually be faster and more accurate, for example, in trying to come up with a valuation number when doing fundamental analysis. Our version of fundamental analysis is to find and follow that main narrative. I will explain it to you shortly how it has happened over the past 2 years, okay? So technical analysis, you've probably seen a lot of videos online saying, I use this indicator, RSI, MACD, support resistances. Those sometimes do hold, but retails should not blindly use them, because there's so many quant funds and hedge funds looking at these indicators, and they know that retails look at these indicators. So obviously, who do you think reacts faster? Retails or quant funds? Obviously quant funds. So if we can't beat these funds that look at these indicators at speed, what should we do then? We should use the charts or whatever indicators to actually spot the institutional buyers of the real money, because those guys leave traces, as we have compared them, like to the Titanic. They leave waves for us to follow. So charts are able to actually spot these waves, and that is because price action don't lie, right? We can actually identify those and ride on. So okay, now after talking so much, let's just look at a live example of how the previous 3 to 4 years have happened, and how you could have, as a retail, made different decisions. So if you look at this chart, there's been a few narratives, which is the fundamental analysis part that we could have caught on. So if you look at 2020, what happened? We had COVID, and immediately rates dropped to zero, and we had this massive QE. So if we had understood that, money supply was a large driver of equity upwards, we would have known that this was going to be the main narrative in the market, right? And indeed, liquidity was the name of the game from 2020 all the way, I would say, until 2021, because rates were very low, QE was still happening. So basically, whatever you bought in the market, there's a good chance you would have made money. So that was the main trend. And if you look at the chart, right, the candles, it's just one way up. It's not actually break at any point. It did not break the 8-day moving average. If you can see here, is this green line. That's the near-term moving average, which indicates strong momentum. So there was no point that it broke. And what does that mean? That means that every chance institutions get, at every dip, they actually bought them up. Because why? They know the phenomenon. So at every chance they get, they're going to put on more exposure. And that is exactly what happened. So then, in that case, you would know that in most parts, as long as those ingredients are there, you can make lump sum investments, right? So then from 2022 to from 2021 to kind of 2022, 2023-ish, we had a period of sell-off, And again, there was the central story that markets were talking about. And what is that? That's the rate hike cycle. That was when a lot of, those companies that rallied so hard just because of those easy money, now their lack of earnings were going to show in their earnings report, and they sold off. So during this whole period, it was so clear that the Fed was hiking rates due to inflation concerns. And you can see as well, it's basically the opposite, right? Every time that there was a rally, it was being sold into. Because all these institutions who have made on this way up, they actually are reducing exposure, right? And if you are retail, yes, buy the dip often works. But if you know that you are in the center of a big narrative that's negative, I'm not talking about things like a sudden bad data print, etc. It has to be a big narrative. So in this case, you would want to hold off making lump sum investments, because again, it would have been impossible to time this dip for as long as the narrative was of a rate hike cycle. And then came 2023. So what happened here? I'm not sure if you guys recall, but that was when ChatGPT was released, and we had a theme that emerged that is so strong that it overcame the rate high cycle. And that is the AI mega theme, right? So on one hand, we could see that there was the AI theme developing. Okay, maybe at the start it was not so clear, so it's okay. You don't have to make that lump sum investment at the start. So by the same time, the Fed hiking has stopped. Fed was holding rates steady, even though it was quite high, but at least the hiking narrative has stopped. So you know that these two narratives, Fed hike stopping, and the AI theme coming up, these two narratives are again very strong, right? So once the chart shows you that, again, as it's holding above the green line, you can see that momentum is strong again, you can just make that lump sum investment, right? Even though it may already been like 5 to 10% off the lows, it doesn't matter, because you know the trend is there. So if you've invested even in 2024, when the trend has been there started forming for almost a year, you wouldn't have been late, because the trend lasted all the way till now, right? Case in point, the two charts I showed you just now, this one, the two charts I showed you just now, this one was during Liberation Day, and this one was thereafter. So, as you can see, Liberation Day did not form a trend in the end, because that's something that was instantaneous, and it could actually be fixed easily, because in a sense, it was caused by one single human. So it was fixed almost as quickly and as easily if that human wanted to fix it, right? So it didn't form any, downward trend. And instead, if we focused on the main trend that was still there, we would have been able to continue adding there. So in future videos, I can actually explain how we could have, identified that institutions may have been overreacting during the Liberation Day sell-off, so that next time in the future, if such scenarios happen again, we could latch on it. And maybe just a quick thought of where we are at right now, which is probably what you guys pay attention to in these markets. Where we are right now, of course, this trend is still intact. So you don't want to, go short for sure. You don't want to go against the main trend. We should still be looking for dips to buy in this trend. However, of course, at this point, the AI theme has become quite mature in the sense that the Magnificent Seven and the AI theme is almost carrying the S&P index, right? So if the earnings of any of these major tech companies have a kind of a doesn't live up to expectations, we could potentially see the index correcting, anywhere between 3 to 5%, which is all a healthy correction. And as long as, the main trend is intact, we should continue to use this to make lump sum investments if the dips goes to, maybe 5% on top of our DCA. So, yeah, that's all we have for today's episode. Again, please, if you like this video, give it a thumbs up, leave a comment as to what you guys would like to see, and subscribe so that you don't miss future updates. Thank you.